And since we are looking at real estate as an investment, I wanted to show, part of that migration, like we said, and I have other PowerPoints, I don't have it in this one, that show that many of the people who are moving are not in a position to own. So they're not moving to do what Ben did and just buy a cheaper house. They're moving to get cheaper rent and a bigger house because can't necessarily afford to buy. So are they going to rent a house or a multifamily? Well, again, before the coronavirus, there was 28 million households in multifamily and 16 in single family, with lower median income for multifamily and higher for single family. What we're seeing, especially after the last 3 months, is more movement towards single family home rentals because, of course, people don't know if this is the new normal. We don't know what's ahead of us, and they don't want to be cooped up in apartments necessarily if they don't have to, if they can move and just maybe out to the suburbs a bit and pay the same rent, or maybe slightly more, but not much more, and have a yard and a little bit more space and maybe a room for a home office if they're going to be working from home more. So these are.
There's my map, Ben.
There it is.
There's the map, and there's
these are the areas where we have identified areas that have everything we talked about. Not all of these areas have strong population growth, and if they don't have strong population growth, they have something else we like, and that's usually cash flow. But on the lower, southeast part, and from Texas east, those are areas where there's just really strong migration patterns. We've got Dallas, Houston, Atlanta, Birmingham, Huntsville. What else is on there?
Montgomery, Orlando, Jacksonville, Tampa. I mean, and Kathy, when you said earlier about the violation of the 1 million rule, I mean, the Alabama, Birmingham fits, but Huntsville up north and Montgomery down south, they don't really hit that 1 million mark, but they have other things that we like, that especially in the case of Huntsville, that kind of makes up for that. The NASA factor, the big Toyota plant that just opened in Huntsville, and just the military and the strong research and development mentality. So a lot of people love Huntsville because it's a very hot market. But yeah, it is. I think it's about a 430,000 population. So you weigh the positives and the negatives, and those standards that we went by earlier, they're not absolutes. They're guideposts that we shoot for. And then up in the upper Midwest, there's all those ones there: Detroit, Chicago, 3 different places in Ohio. Now we've got Baltimore, which is a new market for us. And so most of those hit all the check boxes of what that we're looking for, but there are some exceptions.
Yeah, where you might not see massive population growth, but we see really important employment growth. Like again in Cleveland, just the whole downtown is like a medical hub with the Cleveland Clinic and university, like this whole medical universities around downtown. So when you can buy a house for under $150,000 and rent it to somebody who works at the local hospital, it's pretty great. I've had one tenant in Cleveland in my property there for almost six years now. Same tenant.
Nice.
And works in the medical industry and makes his payment every month. It's amazing.
And what University Hospital and Cleveland Clinic are doing, they're giving like nurses deals on houses. So to buy houses in the area around the hospitals.
Interesting. Yeah. Okay, so these are the areas that we're currently in. That could expand. There's obviously other really good cities too. Those are the ones that we're focused on. So then how do we choose the neighborhoods there? Tim, Ben, you want to cover that?
Yeah, I'll give a shot. You guys jump in. We're looking for owner-occupied areas. 70-30 is kind of the rule of thumb that I usually look for in the areas. Medium income, and we want to be close to stores, grocery stores, restaurants. You want to have low crime, and you want to be around jobs. And I know you said that earlier. And a new thing, Kathy, if you want to talk about a little bit, the build-to-rent SFR communities are the future, are coming strong.
Yeah. One thing to be aware of is we really do like to be in mostly owner-occupied areas where there's maybe 30% is rental. But then there are some areas where it might be higher. And if there are strong HOAs or something in place that makes sure that it doesn't look like a rental neighborhood, but it's staying, strong, then make the exception. But be really cautious there. If you're buying a new home and it's just a builder who's buying lots in different residential communities that are mostly owner occupied, that's great. If you're going to be buying a house in an area that's 100% rental, it would be best if that was all managed by one property manager, like a horizontal apartment, rather than having 100 different owners with 100 different property managers and different styles. So just be aware of that. Okay.
Yeah. And the whole theory behind that, and most people know, is that owner occupants generally over time have more pride of ownership, and they take care of their places a little bit better. They paint things, they upgrade the hose and put a good hose bib on and whatnot. So the properties tend to hold their value. If you go in some place that's predominantly a rental village, then you have no control over what's happening around you, and it may actually depress the values.
Yeah, and the reason why is, like Florida, there's a lot of infill lots still you can purchase. Other areas like Atlanta, you have to buy a bunch of land, and kind of that's one reason why it's hard to do build to rent in some areas because there's not as much land. But like Florida, though, there's all kinds of infill lots that are working where people can buy new properties right into an occupant area, which is awesome.
And like, for example, to Kathy's point earlier, our Atlanta affiliate, I mean, they've connected with developers that are building huge subdevelopments, but they stipulate that they're only going to sell 15 to 25% of their lots to investors. So there's your assurance that it's going to be at least 70% owner occupied long term.
And they spread it out along the development, which I think is really cool.
Yeah. Absolutely.
Yeah, so always ask that question when you buy a new home is, what's the percentage of rentals in there? Because we have seen some groups just buy the whole subdivision and rent the whole thing out. Again, as long as it's really tightly managed, like an apartment with maybe one property manager in place to control things, that can work out. But we've seen it not work out when, people are self-managing, or they've each got a property manager who's got different standards. If that one person brings in a tenant that perhaps likes to do their business right there, selling things they shouldn't be, then it can bring down the value of the neighborhood. So we really want somebody that's controlling that. Okay, so then within those neighborhoods, finding the right team is the challenge. Depending on what you're looking for. If you're looking for somebody you live in California and you want to buy a property in Florida or Texas or Georgia, Ohio, and the property's older, and so you want that, you want it fixed up, you want it to be renovated and then rented, boy, you've really got to make sure that you've got the right team in place for that. If you're just going to go buy a property and do the renovation yourself, or you buy a new property, it's a little bit different. But if you are depending on somebody to help you find the right neighborhood, the right, a property that's really got rental demand and is near jobs and what we just said, and then they're going to renovate it for you in what some call turnkey, which really there's no definition of what turnkey means. So it's don't trust that word at all. We've seen people call turnkey something where they just put a new carpet in, and
right.
But a lot of people call that word turnkey. But if you're going to buy a property from somebody that lives many states away and is going to renovate that for you, there needs to be oversight there. And that's where Tim comes in for RealWealth. So Tim, tell us how you choose these teams who do the renovation.
Yeah, thanks, Kathy. Yeah, this is the secret sauce. I come from an operations background, so I'm a big believer on boots on the ground and getting type A people, give them expectations, set the standards, and then let them do their thing. So we're looking for at least 5 years of experience of a company that's been doing it. So they're going to go through the ups and downs, and so we don't want to learn on our dime. So that's kind of the reason there. And then they have to own rental properties. They have to understand how rental properties work. And I really look for core values. So it's really important that they have the same core values as RealWealth Network does. And then we do our searches. We do our negative reviews. We look at quality website. We look at their websites for how what kind of quality it is. We do a Ben verified background check. And then the most important thing that I do is I go visit them. So I talk to the team. I spend a lot of time with property management. Then I have them show me houses that they just purchased, house in the middle of renovation, a house that's finished. I look at their standards. I look at their supplies. I like to meet the head of their contractors. I like to look at certain things that I've learned because I used to have a turnkey company way back in the day. So certain things I know people skip on, like looking underneath the sink and make sure the right plumbing's in there and just little things like that. Just making sure they're getting the details is what I look for.
So
yes.
Go ahead, Kathy.
Well, I just, it takes a lot of oversight, but at the same time, you can't control everything because we
I
don't
can.
own those. Is that what you're going to say?
Yeah, I was gonna
Um,
say, yeah, yeah.
we don't own these companies. These are companies that Tim has identified that fit our standards or that will adapt to our standards, and they're willing to be trained and do things the way we want them. And he's, inspecting, but because he's in Ohio and these properties are in other states, and we are only licensed brokers in California, so we can't actually talk to you about specific properties. We can just give the big picture. Because you have to work with the broker on that end, and Tim is not there walking through those properties, you've got to make sure that you do your due diligence, that you, again, get your own inspections, get your own appraisal, go see the property if you can. If you can't, get as many photos as you can of the before and after work. And then, so Tim and Ben, this would be a good time to just ask you guys, when people have not had the most positive outcome, why was that? Is it something they missed in their due diligence?
A lot of times, I just want to answer one quick question that came in.
Sure.
Somebody has a question here. What is an infill lot? And I just wanted to address that really
Thank you.
quickly. So we'll go back up to this, but essentially is a lot of our property teams are now building brand new from the ground up. So there's two ways they can do it: with a subdevelopment where they're just building a bunch of homes all in one spot. Infill lot meaning an existing neighborhood that maybe is 10, 20, 25 years old, but there's a couple of vacant lots in there, or maybe there's an old crappy house that needs to be torn down, and then they put a new house on that. So that's what they mean by infill. You're taking an existing neighborhood and putting a new property on an infill lot that's not part, it's not part of a big subdivision. But back to your question, Kathy, I think a lot of people trust too much. They trust us, they read and they see and they watch and they view and they take it all in, but then they need to do their own due diligence themselves. And one big mistake that people make is they don't get an inspection. Most everybody does, because we drum it into them over and over, and we say it at every webinar and every strategy session that I have and my team, we say it, but sometimes people don't do that. And then if an issue does come up years down the road or even 6 months down the road, they don't have that nice little document, multi-page snapshot in time of the condition of that particular property on the day that they closed it or shortly beforehand. And it's so easily taken care of. And I always tell people the inspections pay for themselves, because there's inevitably going to be half a dozen things that they point out that you then, as the buyer, ask the seller to fix for you, which would cost you $450 to do. So that's the most common mistake.
Yeah.
And properties are complicated. I mean, they are, because there's a lot that goes into it. It's not a widget. So that's one of the mistakes people make, is some companies sell properties as widgets. And what I mean by widget is just a production piece. There's a lot that goes into it. And then you also have the tenant. So sometimes the tenant looks great, but sometimes we can't predict what a tenant's going to lose their job or death in the family, those type of things. So those things do happen.
Yeah, so that's why no matter what, always have your 6 months reserve set aside.
That's right.
6
And
months.
it's long term. It's long term. That's the big key to everything. It's long term. So if you do have a tenant that moves out, it's what do we at 3 to 5 years? Look at the big picture. That's where you make your money.
I mean, you'll eventually pay off the underlying loan. I mean, that's the goal with most people. The overwhelming majority put 20% down, finance 80%, and they make $200 to $400 of positive cash flow a month. But most of that is either set aside for reserves or used to expedite the payoff of the principal. So it's just kind of a break even. You're making a little bit of money here and there, but you're using that to pay off the home. But eventually, maybe it takes 18 years, 15 years, 12 years, you'll own that home outright, and now the real money comes in. I mean, real money meaning, $700 or $800 a month, but you own 10 or 12 of them, it adds up to real money. So I think people sometimes forget. They get, just like what Tim was just saying, they get lost in the weeds, like, oh my God, somebody moved out, what am I gonna do? Well, but that's going to happen. It's part of real estate. But if we look 10, 20, 25 years down the road, in the long run, compare it to the mutual fund with Fidelity, and most likely the property will win, usually.
Yeah, look at the equity you'll have at that point, and you get reverse mortgages when you're retired. I mean, there's a lot of different things you can do at that point.
Yep.
Yeah, I mean, a really good example is a property I owned in Cleveland through a property manager there that just messed up. And these are not companies we own. We rely on other people to run their companies well. And the most control we have over them is we say, if you don't take care of our members at RealWealth, well, we can't refer people to you. So, fix it. And if they don't fix it, they're not on our list for referrals. But at this time, this guy just kind of imploded, and he kind of got over his skis and started to use rental income for expenses for the property management. And so when we started to notice, it was about 2 months in where we hadn't received our rents. So you want to let us know, or be on top of it right away. If you don't get your rents right away, find out what's going on. So we didn't, and there was probably, I don't know how many of us, 10 of us, I was one of them, that by the time we realized it, the property management company imploded. We lost 2 to 3 months rent on that. And there were some people who were just absolutely devastated. And there were others who were like, oh, well, let's move on. Well, that was, I don't know, 5 years ago. My properties doubled in value in that time. I'm not saying it's going to double in value again over the next 5 years, but it did. And so the loss of those 3 months is nothing. It's really nothing in the long term, and no need to lose any hair over it.
No excuse for lousy management, but you just have to keep your eye on the prize, and the prize is the long-term goals, the long-term outlook. That's what it is. This is a long-term play.
And I think more than ever, with the amount of money that is just being printed, unprecedented amount of money being printed by the Fed at this time. Every time that has happened in the past, it drove asset values up. So I wouldn't be surprised if property values doubled again over the next 10 years.
And just the articles that I sent you yesterday, Kathy, that I was looking up, is single family homes are exploding. I mean, it's unbelievable what's happening. So it's definitely, we're not the only people thinking it's a safe bet.
No, you got more and more REITs coming in, and Wall Street companies coming in to buy. So we don't like them in our little area, but they're only about, I don't know, 3 or 4% of the industry. The rest of us,
and they don't have the personnel, the family orientation that we build.
Yeah.